do you believe, like some do, that the housing component is likely to fall, or do you think it's going to remain elevated here as we go throughout the rest of the year and into next year?
Well, if you're looking at, oil prices is a critical place to start, and that's because oil affects all prices, particularly all goods, and to some extent services prices. Those prices, oil has remained elevated. It looked like we were getting a little bit of decline in oil, but that's bounced back up, and so the big disinflationary impulse that existed last year is not happening. Oil's basically flat. So then you turn to goods prices. Goods prices are now, basically back to pre-COVID levels of inflation. And a lot of those sort of big disinflationary impulses, like things like used cars and things like that, the price level has come down to the point where we're now at levels that would be commensurate with the rise in nominal incomes. So the odd that happened over the post-COVID period. So the odds that we're going to get a lot more disinflationary impulse from those prices are not very good on a forward-looking basis. Look, month to month, who the heck knows what's going to happen? I'm just saying, like, auto prices, they're not going to fall another 25%. Used auto prices aren't going to fall another 25% because incomes are up a lot. So you don't want to look at pre-COVID prices as your benchmark because incomes are up 25% on a nominal basis. And so odds are those good prices are not going to fall nearly as much. And then we turn to housing, and really housing, it's all about all tenant rents. And when you look at it, which is very different, a lot of people focus on new tenant rents. That is misleading. That's not what drives OER. That's not what drives actual paid for rent. What drives actual paid for rent is all tenant rents. And the Fed series, which captures those, suggests that we're still seeing inflation in the 5 to 6% range on an annualized basis of all rents, in part because there's a big catch-up to the rise of new rents that existed in the post-COVID period. Those surged at double-digit levels at one point. And if we're at that range, we're going to see house price inflation that remains elevated compared to pre-COVID levels. And so you take services inflation, which is elevated to pre-COVID levels, housing or shelter costs that's elevated relative to pre-COVID levels, goods prices that are probably going to be a bit above where they were pre-COVID, given the disinflationary or the deglobalization dynamics that are occurring, and oil prices that are flat at best. And you add that all up, and things are a little too high.